Welcome. Hi, everybody. It's Adrian, CryptoBirb speaking. Welcome to today's Friday webinar. Straight off hot, very hot Dubai, 35 degrees, beautiful weather, beautiful sun, cloudless environment, and many surrounding of the beautiful buildings up here in GLT. Brilliant greetings to everybody in top of the day, to the best of the people. And we are opening this very live stream with a quick news because we have pretty good announcement to share with our brand new partners, as well as very data that's just flown in, just in as the inflation in many European countries reaches over 17%. How this is all going to impact Bitcoin and other markets? Well, this is exactly what we're going to try to break it down and find out. And if you're ready to hear in this, make sure you stay tuned. We are going there right in a second. Welcome. It's Adrian CryptoBirb again. I hope, guys, you are doing brilliantly today. Beautiful weather, like I said, here up in Dubai. Very hot. Hope you guys are staying out safe because I know there's, a lot of bad things, a lot of hurricanes and a lot of natural catastrophes going on all around the world. I know the Florida is not really doing good, I guess, for the hurricane. So I hope that everybody is surviving and doing as good as they can, basically, to stay and remain safe. All the best love to you guys. Make sure you hold on tight. And we are all in this together. So if any of you kind of like always need help, my Twitter or DMs are always open. So let me just rally straight and right into the very details. Like I said, I'm very proud and honored because we've just partnered, the Burmese, my firm, just partnered with Origin Protocol. And Origin is one of the massive projects. They have only recently just surpassed, I think, 160,000 followers. It's 162 and 3,000 followers on Twitter. It's a very massive project, brilliant team. Brilliant, big names who are very professional about what they do, and they are going to bring the connection and real use cases to NFTs and DeFi to the masses. And this is already what they've already started doing because they actually mentioned this massive announcement yesterday. We were talking about it on live on the spaces where they partner up with Roofstock, and Roofstock basically is one of the big real estate companies in US, and they are going to combine and custom build a marketplace for real estate purchases using NFTs. This is the first ever world use case of you being able to buy legally and fully compliant laws and regulations to it, NFT with basically whole setup, right? So you're getting to go through NFT and become a proper owner of the apartment. This is pretty good for anybody who's interested in real estate, but this also goes way beyond any kind of like JPEGs that you have. Like some of you know, I have and own, the basic for the Yacht Club. So, I'm much invested into NFTs myself, and I'm definitely looking forward to seeing how it all propagates, especially with the real use cases. And they're going to build it, well, more and more as we go. So I'm pretty looking forward to it as well. Excited about that. Congratulations. And the next point is, like I said, this is just in data. We've just got confirmation that inflation in Poland is at 17.2% year over year for September. This is like a quick calculator, quick estimator. Being given, we also know that Netherlands is right behind, at 17.1. Those are staggering numbers. Year-over-year inflation at 17.2% is staggering number. And this is not really what I think the regular users, but regular citizens, if you will, regular workers, in the country, any country whatsoever in the globe would love to see. As we're not only talking about double-digit inflation, we are actually surging into two in front, right? So imagine 20% inflation or higher. Well, it doesn't seem too far anymore, right? That's the problem. And as we are reassessing, as we are basically, fooling ourselves, I guess, with changing the definition of recession, many countries would try to provoke, different thoughts and changing the definition of what recession is so that people would be tricked into not believing, we're in a recession, but we are in a recession, and that's very big major part of the global economy. And the problem is that the recession, seems to have barely started recently, and it typically lasts for quite some time. And it's typically led if we want to, see any sort of like an upturn on the recession side, we have to first see the stock market's upturn, right? Typically, there's like 6 to 9 months of a preceding effect for when the stock market kind of like returns, when it recovers, starts recovering, gets through this major bottom truth, then this is only after this kind of like 6 to 9 months, typically for the model behavior and the business cycle that lags about the 6 to 9 months, just like I said, behind the financial cycle. So see the stocks first, bottom, then we may have actually anywhere between 6 to 9 months on average until the economy starts expanding again. Until then, we are in contraction, and this contraction seems to be getting worse and worse as the data coming in from many, forecasting indicators, this is not really looking too good. So having that in mind, we can definitely give it a check to how the markets are performing. So right ahead of the market open, we are truly looking at the set of new lows being made for the industrial average. Dow Jones Industrials are basically cutting and smashing through the prior swing low of June and below 30,000 points. Right now, we're talking about equaling, summer, tapping 29,000 points. This is not really good. The new lows for is not too much promising. Similar, though, for what we are seeing, the composite index, the Nasdaq Composites, which is a little bit of a risk barometer, more risk aggressive, risk seeking. Here, truly, we're looking at 10,500 points being tagged. So it's basically the June lows repeated out there, and with even less of a defense line at 3,600 for the S&P 500. So the SPX, the S&P 500 large cap index, is basically looking and printing, piercing through the June's lows as well, following what the industrial average does. This is, call it whatever you will, this is not too much positive, mainly also because we, like I mentioned, last week, we did manage to overthrow and fail on the breakout on top, right? Rejecting the 200-day average, which was the very peak of the bear market rally. At the other day, I was actually preparing, tweet thread on it for whether or not the bear market rally was over, and it does seem that it was over already. We can actually, just like I said, go back. I'm pretty sure I have it somewhere in the bookmarks. There are quite a few of them. But the problem is that, there you go. Is the stock and crypto market bear market rally over? Where we were talking about the bear market rally when the stocks and cryptos were performing fairly okay. And the very conclusion was that if I were to guess, I'd say that the bear market rally was over. It doesn't look too promising for the risk on assets. So I hate to be right about that. Probably there was some factor of luck to it. However, we were looking at the very bear market rally, and in fact, at that very day that S&P 500 touched and tagged the 200-day average. So right now, having this setup where this rejection kind of like followed through to the downside and continued to fall and collapse, and we're talking about the set of new lows and fairly little to no signs of strength, I should say, to the risk basket. So here, S&P 500 smashing, basically piercing through the June lows is not really too much promising, mainly because the failed patterns which we had on top in here, failed patterns tend to perform better in the opposite direction. We had an initial upwards breakout, which by extrapolation, could have printed and yielded, a little bit higher prices. However, the pattern remained, or actually was proved to be failure, right? It was a pattern failure, the top breakout failure. And the failed patterns tend to perform better in the opposite direction, right? So the opposite direction may easily take it further beyond the lows. And this is exactly what we're looking at right now. And after a vulnerable close yesterday, I would argue that we are not really looking at a very promising setup for stocks. Here on the energy market side, we are looking at this little bit of a struggle at the 200-day average. However, the odds are fairly on the opposite edge, right? As the stocks, the risk on assets, the S&P 500, Dow Jones Industrial were in a fair bear market, somehow at times interrupted by any sort of like small, tiny rallies. Those rallies tend to be short-lived because we are talking about the primary downward trend. Here, the odds may be fairly inverted, mainly because we're looking at ascending 200-day curve, 200-day average price for the XLE, which is the energy sector of the S&P 500. There, we are truly looking at an ascending sequence of a bull market and an ascending sequence of a medium-term trend. So both 200-day trends, long-term trend and a medium-term trend, are moving upwards, or moving up, while the 20-day mean has just crossed over below, to the downside over the 50-day average. So this tells me that within this overall bull market, strongly defined, the 200-day average and the 50-day average, we're looking at a little bit of a worsening, a little bit of a weakening on the short-term basis, right? And this short-term basis, of course, left this major massive gap, a couple of days ago. And gaps like to get filled typically because of the volatility reasons. So I would not be surprised if we actually just see an extended this local bounce a little bit towards the 75 points here per the chart. However, that's not a promise, right? That's not a guarantee. We don't know what the market is going to do for sure. And that being said, we are looking at this little bit of a struggle, and this struggle could be potentially more promising for the risk assets, because the energy sector, when it's expensive, when the energy stocks are running, when the energy and gas prices are expensive, are moving up, this typically drains out the the liquidity, just to put it simply, out of the other markets, out of the risk assets, right? So the real disposable income actually just decreases as well, because you have to pay this hidden tax in the form of the energy prices. So, and despite it's not called a tax, you're going to have less money in your pocket to spend on your investments, to put it into financial markets, which dries up basically the liquidity, the amount of traders, the amount of money being put and held in the markets, which typically is more bearish than not, because there is not enough of demand to keep the prices up. So all that being said, guys, I hope it makes sense so far, because we are about to head in the bond section and on the treasuries there, regarding the bond prices, which are of course not really looking too good. Very, very strong instance of a bear market, which keeps accelerating to the downside. You can tell this is not some sort of like a linear movement up here. You see that there is this very strong advancement to the downside. There's very strong pressure as the market kind of like seems to be taking more and more hits, right? You can tell that these extrapolating trend lines, they are accelerating to the downside. This typically means that there is a very massive sharp decline in the short and medium term, which is actually fairly confirmed, of course, because we're looking at a massive downward trend at 200-day average, very strong bear market in the bond prices, very strong as well performance to the downside on the 50-day trend, and even further, more deviated against one another, increasing the distance constantly here between the 50-day trend and 20-day trend, which tells you that the short-term bears are exiting in force and in aggression the 50-day trend up here. And this comes with historically high yield prices for 10-year yields. So the treasury notes here are basically looking and just leaning outside the window, over 40 basis points up here. So 4.0% is what traders are pricing in. Of course, there's a little bit of a hiccup, a little bit of a sideways forming after getting this, this massive break into the 40 level. However, I would argue that, having this very opposite case to the strong bear market in the bond prices, we are looking at a strong and strengthening, accelerating advance in the bull market scene. So this is something that I would definitely not be brave enough to kind of like cut it short or counter trade it. And I'm saying all of this mainly because many people have this tendency to kind of like, fall for this regret bias, for this recency bias, for misrepresentation bias, and representativeness bias, and many, many other emotional and cognitive biases, including the cognitive dissonance, where they would have and measure based on small sample of data and believe that the trends are going to continue like that forever, or just because there was just been a tiny reversal on top, that it's going to continue, expanding like this for long, unforeseeable future. So, but this is not necessarily the case, right? And this is not the case mainly because the trends are looking extremely strong, and this moving average is a synonym of a trend. So we are talking about the long-term trend, medium-term trend in the middle, and short-term trend. So all of the trends are pointing upwards and they are accelerating from one another. They are moving up faster and faster day by day. This is the real strength. This is the real essence of the technical chart, right? It's showing you the direction of the market and there is nothing bearish about that. The trends are not curving down. On average, the prices continue to surge. This is what I would never dare to counter trade or cut it short. Like I said, mainly because it's going to be fading the trend or actually fighting the Fed. And the very old wise saying says, do not fight the Fed. Here, looking at the performance chart of the S&P 500 sectors here, again, the top performance remains under the category of the XLE. So XLE year to date is 35% on the increase, a little bit of a decrease on the utilities here. Still, definitely on the leading side of the market, despite it's just, got this tiny little dive below the 0% break-even level for the year to date performance, minus 5%. Then looking at most likely at the consumer staples at minus 10% and the healthcare minus, to be specific, almost 12%. So we're talking about the defensive stocks here and the offensive stocks or the risk assets here with the main of the communication services yielding close to minus 40%, minus 37% as we are going year to date. This is fairly a clear picture that all of the stocks but the XLE, but the energy are pointing downwards, are moving downwards, and that the things are not looking too good for the stocks overall. So even not just the offensive and risk assets are pointing downwards and printing new lows, but it's also the defensive stocks which are basically taking a hit down there. So by looking at it, this is the very reason for it, the very strength of the dollar index. The DXY index has been basically printing relentlessly new highs upwards and upwards, higher and higher, well beyond, I would argue, what seems to be a common sense. And it may happen that, of course, with such a strong currency, the global sales is going to be thrown into a question and a big question mark because high costs being paid for global sales transactions, in the global reserve currency that the dollar happens to be. I would argue this typically slows down such sales because typically the contractors wait for the cheaper cost, for lower costs coming from cheaper currency in order to exchange them. So by looking at it, by looking at each and every other currency basically being strongly moving downwards against the dollar, then dollar taking the lead and piercing, right at 115 basis points in here. 115 points takes us back over 20 years. So this is new 20-year high basically for the dollar. The 50-month trend, which is this kind of like a moving average, this smooth curve, at 96.62 is breaking to new highs unseen, of course, also like from 2003, 2002 periods. So long story short, the very strength of the dollar, this very apparent strength of dollar is taking and drying up the liquidity from the stock market as a whole, and even the defensive sectors are really taking pants down. So it does not really seem that with such a powerful breaker that we're looking at here right now for the dollar, that the dollar would be willing to kind of like stop anytime soon, right? Typically because of the momentum principles, the outperforming assets are going to continue to outperform more likely than not. It means that once such an aggressive trend is started and it's going more and more vertical, the harder it is to actually stop it, right? Because this is the money that moves the market. This is the very money stream moving the market. It's like trying to stop, the river stream. You can try to stay, counter to the stream for a moment, but eventually you're going to, lack the strength and you're going to get exhausted. So same here, once such a major massive trend develops, it's very difficult to actually stop it. So I would argue it has much better chances to continuing to push higher and following through and well, it does seem that the major next resistance may be based on the technical level, just accounting how fast the trend develops. Some are closer to 120 points. So by just taking this measured rule movement and measuring this rectangle, this range bound, trading range bound box, whatever you name that rectangle, you're taking the base size measured from the swing lows to the swing highs and actually put it, as well, try to extrapolate it in the vertical sense, in the vertical matter, adding the target, the base size on top of the breakout level, which actually yields and results in a sort of a technical critical resistance defined by the chart. So here looking at 120 points, of course, it does find correspondence with the past highs of the dot-com bubble. And we have no idea, to be honest, if it's going to get there, if it's going to stop there. However, this is what the technical chart is telling me. And me being the technical trader, I choose to try to trust the charts. And of course, like I said, this definitely brings a lot of tensions and a lot of, I should say, bull market rallies against against other currencies. So dollar surging basically puts the Polish zloty, just for instance, over this massive 20-year high, 22-year high, value at basically 50, right? So 50 right now 498, but it's fairly gone better upwards. This is a very, very sharp increase on the 200-day moving average, which is the long-term trend, which is the bull market. So you can easily tell that there is this massive breakout on the bull market side after this little bit of the consolidation, if you will. Of course, we had, just some moments like ascending triangle or something. I would be, and I'm honestly not paying too much attention to the frames that we put on this pattern, the way we frame it, the way we phrase it, if it's a ascending triangle, if it's some other triangle, if it's basically some consolidation. It doesn't matter too much because what we're looking at is the breakout out of this. So the very name of it, to me, looks like an ascending triangle, but it can be also any other form of consolidation pattern. But here we are looking at this massive surge and breakout to the upside, which actually makes this name of the pattern completely irrelevant, because what matters is this existing strength of the dollar against Polish zloty, especially with inflation at the rate of 17.2% per the quick estimation. So I would argue that, having this massive surge, again, on the 200-day basis, massive breakout out there, it does not seem that Polish zloty is going to basically appreciate against dollar too much in the near foreseeable future. I would argue that the dollar, by being and showing this very presence of significant strength, and that is breaking and accelerating on the short and medium and long-term basis, I would argue that the Polish zloty may continue to lose against US dollar. And especially, like I said, that we are talking about, about the very, very high pricing and evaluations, basically new all-time highs for Polish zloty as it passed the registers of the trading view up here. And even if we take it, for the Swiss franc, of course, this is also going to be showing even more strength. Let's take it back to the monthly chart, and what we're going to see, of course, that this is also trading in the new high, so it's showing exceptional weakness of Polish zloty against the dollar and against Swiss franc. So it's not only just as much about the strength of the dollar, but also about this, lack of strength or weakness against other currencies that Polish zloty has. So it's typically not the best sign, if you will, for the currency, right? So Polish zloty may actually have, just like it was this massive spike the other day coming with the financial attack that it was in 2015. Seeing just this, we are already surpassing those levels. So this really makes you think. I would argue euro to Polish zloty also, also yields very, very high prices close to the all-time highs. This also makes you think. And GBP to US dollar, of course, cable to dollar, is looking at the new all-time lows. Already printed, right? This was printed, of course, and have a look at this magnificent chart. I would argue that this is a very serious point, right? Having the lows up here at 1.05 for GBP dollar. Then right now, is curving a little bit up. It's having a little bit of an upwards price action, if you will, on the short-term basis of the following, this massive crash, this massive flash down the toilet. And of course, as the British government announced that they're going to, they're going to start buying back bonds, basically to save the currency, right? So here looking at an exceptional strength from the dollar. It's crashing really the relationships that it had before with many other currencies, including the GBP. And arguably, if there is a close between or below the monthly close, which is today, and it does close below the all-time lows, I would argue this is not really the most bullish and positive scenario for GBP currency, or for Polish zloty, or for euro, or for any other currency, in all honesty, because dollar strength has been prevailing and it's been very apparent and strong. And I would definitely not be brave to counter trade it in any form or way. So all that being said, guys, is really making me think that having as much recession, already processing, we have this, final confirmation for GDP growth for Q2 this year. This final confirmation also confirmed minus 0.6% negative growth for the GDP for second quarter, confirming, adding yet another confirmation to the fact that we're in the recession. Inflation is still soaring up 17% over for many European countries. Of course, US is not really looking too good either. The estimations, if you remember, for the CPI went, it went a little bit bollocks there, because the real CPI data that came in, that flew in, was worse than expected, which also puts a lot of risk assets into further risk. And it does not seem that having the recession and having so much risk, and even geopolitical risks and high energy prices heading right into the winter, there is too much of positive positivity and optimism, if you will, for the risk assets. So taking it further to what Bitcoin is trying to tell us, I would argue that the longer we stay below 200-week average, of course, historically, it used to bring good counter trading opportunities for the long term. However, it's not necessarily the most bullish case scenario for the short term, right? So having the 7-week correlation coefficient at 0.61 to S&P 500, Bitcoin remains in proof strong directional connection between what the stocks do and what Bitcoin does for the prices. So having this so many negative factors to the stock side of the market, with the very apparent strength of the dollar, Bitcoin is more likely than not to follow what the stocks do. So if the stocks continue to dump and continue to basically move down, Bitcoin may do so as well. However, it's been holding relatively well and steadily, against the dumping markets, but it's still just a tiny little bit of relative strength against the other stocks, and it's short term and it's temporary, mainly because the tiny difference comes from the fact that many stocks already printed new lows, just like you saw for the S&P 500, SPX, in the very beginning of the show. But while Bitcoin is actually just holding the line closer to $18,000-$19,000. I'm not saying this is the bottom. It could well be the bottom, of course. However, the odds are not looking too positive, and it does seem that if there is this massive deterioration continuing to build on the economy side, on the inflation side, and I'm talking about the inflation increasing and the real interest rates actually going up, continuing to go up strongly and more strongly than anticipated, then I would argue this doesn't yield too much of the positive, promising returns and results for the risk assets, including Bitcoin. So here, historically, like I said, $25,000 right now, 17,500 is at the bottom. June's lows are still defended. We'll see for how much longer they are defended. Well, in all honesty, again, we'd already been quite some time, over here in this sideways period. I would not be surprised, like I said, if we actually just manage to get lower, get this final flash, if the economy really continues to shrink, and there's this massive event trading day, if you will, or this massive, opportunity for the bears to take over, and many stocks which are already printing new lows. So I would argue if this is the case, and we really are to see this massive flush in the stock side, then Bitcoin may actually follow through to the downside and also take us lower towards, like, even imagine $10,000 to $15,000, 10 to 10, $14,000. Nobody knows what's going to happen. Nobody knows where it's going to happen, when it's going to bottom out. There is no fixed rule or saying that the bear market must last, no more than 365 days, or the market is wrong or something. Instead, we as traders, as technical traders, have to stay and be patient about, resurfacing of the trends. We want to see the trends resurface finally and emerge all over again after this massive sideways period that we're looking at right now. So 2022 has been about a lot of bearishness, about a lot of sideways environments. And not honestly, the picture is that a lot of downside movements followed by sideways and very little upside reaction historically so far year to date. So here, just looking at it, like I said, on the weekly chart, from the perspective of the trends, of the trend breakouts, we're looking at the $30,500 as the main resistance level in the proximity of the main current after trailer resistance at 30384. Okay, so this tells me that as long as Bitcoin trades below $30,000, it's not going to be confirming the new bull market, if you will, which makes sense, of course, because this is definitely one of the strongest resistances right now in the chart. X support, which used to hold the line for the bulls and against the bears, saving from Bitcoin's collapse, which actually later on happened in May from the Luna crash. So all those things concerned, taking it even to the 12-hour chart, I would argue that we are still on the bearish node. Because the sideways patterns, like to chop around. They don't really like to show any sort of like a market direction. Instead, they chop around, not revealing any consequence, any follow through, any persistence in specific direction. Instead, they kind of like chop around, trigger signals in both ways, one after another. There's this, bullish breakout, then bearish breakout, bullish breakout, bearish breakout, bullish, bearish, and so on and so forth. So this is a clump and a mix of bullish and bearish signals printed one after another. And here, looking at it, we're still at the bearish side of the sideways movement, if you will, with the resistance at 20,354. So 20,354 is the main resistance I would see that Bitcoin cares about within this range pattern, this sideways pattern. So as long as this level is not really reclaimed, I would argue that Bitcoin may not really develop or feel bullish about it. And instead, it shows and has better and more favorable odds to go to the downside, even despite it is the sideways. So here, technical analysis can teach you a lot about the trends or about the very lack of this trend. And it also, many people ask me if you can apply NFTs, technical analysis. Of course you can, because the NFTs are also price valuations. They also yield certain price history and bear certain price experiences. And changes, fluctuations. Right now, you can tell that the Bored Ape Club, for instance, is trading over its 50-day moving average, which is this green curve, with the yellow curve basically being the price against ETH. So the Bored Ape Club is actually looking at the local improvement against the 50-day trend, and the RSI here is surging, towards slightly overbought bands. However, at 70, it's still early. And I would argue that there might be something good to it as we continue to move outside the 50-day trend. However, the 50-day trend is declining, so this is the main narrative so far for the NFTs as well, for the Body Ape Club. And if you guys want to learn more, I kindly recommend that we have a 7-day free trial program for everybody who wants to learn, for everybody who wishes to get more reliable, beginner-friendly information to start their journey, to kick off their journey, even if there is not much funds in your pockets. Then this is exactly designed for you. You can come and try out, get as many exclusive premium resources, free of any charge, free of any prices, free of any tags on it. No credit cards, no strings attached. You just come, get us your name, email name, and we're going to get you set up in a matter of seconds via your inbox. So if you guys want to learn about that, make sure you actually just head into the very website of ours, thebermness.com, go into the upper right corner, sign up free button, press on it, click on it, get your email, get your first name, and get your free trial. immediately, this is going to be potentially game changer for you because you're going to get everything you need to start trading profitably. And that has been, guys, Adrian talking to you, CryptoBirb talking to you for the past 30 minutes or so. And if you enjoyed this one, if you watch this on YouTube, make sure you actually click on the subscribe button, smash the notification bells, smash the likes as well, leave some kind comments and questions if you have any. I'll do my best to go and actually follow some responses myself along with my team. And if you guys have any other questions piling up, make sure you put them in the comments, just like I said. And if you don't manage to do it in the comments, then come to the nest, 7 days free, which is where I'm going to cover it myself along with my team 24/7, 365 at your service to help and ease your trading decisions. God bless you all if you enjoyed that. Stay safe and I see you around. Bye bye.